We are mobile home park investors. We have one destination overnight stay RV park, a hotel, and some other assets. But we understand our best asset is a nightly stay RV park.
Technically, our highest cash flow asset. It's a unique situation because we're the only sort of game in town. So
right, we're in a resort town. We don't have any competition.
Park, yeah.
There's leverage you can pull in these nightly stay RV parks where you can go in. There's a lot of mom and pops. They keep the rates the same year round or similar. They're not doing dynamic pricing like the airline model. They're not doing like what we call site lock fees. So we actually bought this park, we renamed it, we rebranded it. This is the one we have here. It implemented software. It was a tech play.
It's a tech play.
And increased the value. We bought it for 2.2. It's probably worth well over $4.5 million now. And that was just implementing dynamic pricing, better marketing. We went from a bunch of staff to one person because all of the bookings happen online using AI and other tools.
Like say employees.
Yeah, the tech. I love how you always say, like, always look at tech before you hire somebody, which is, this is a perfect play. You found this park, you looked at the price and you're like, but you're like, I like the area. I like that it's a destination park. It's like it's not a roadside park on your way somewhere. Like, this is a park people are going to get. It's on a river. It's beautiful. It's got pool, clubhouses, all this stuff. And so you dug in, you looked at the price and you're like, that's cute. But you dug in because you understand the value add play on these parks. And so you dug in to see if there was an opportunity for that. Like, what was your mindset? What's the thought process from the minute you saw that listed? Like, this park was listed on, what was it, RVparkstore.com?
Yeah, it's on RV Park.
Yeah, RVparkstore.com. The whole world sees it.
Yeah.
But if the whole world knew the price that we had right now and the terms that we have, the whole world would be way more interested. But the whole world passed on it because they saw the price and moved on.
Because they don't, yeah.
Yeah, so what was your thought process? You saw it, you saw the price, and you're like, interesting, I'm going to go in further on this.
I think that, like, when it comes to parks, at least, any asset, you're looking for opportunity. For me and for us, I think we look for opportunity for upside. We're not a big hedge fund that has to deploy, or a big private equity group that has to deploy hundreds of millions of dollars and just preserve it and let it grow slowly over time. We're a small boutique investment company. So naturally, we want upside. And upside means increase in or growth in revenue, decrease in costs. One or both of those two things. So initially for me, I look at the price, I give it a little bit of credit, but it's like, I want to know, is there any upside into this park? Can I adjust things? Can I make adjustments to this park to make it better? So I'm seeing that right away. I know that there's value there. There's opportunity to add value.
Right.
So for me, the next step is, hey, why don't you reach out to the broker and just get an idea of financials? Based on the financials, which we're still digging into that, what I'm next trying to understand is what price and what terms would be attractive, not just to me or us, but to investors, to capital providers.
Yeah.
That's a very first.
Always got to think through the lens of an investor.
Right. Because I'm not going to go in with a couple $1 million, neither are you. But if I can create an advantageous situation for capital providers, then we can attract it. So that's the second thought. And then basing the offer and terms, the price and terms off of that. And so the next thing was like, look, if I can come in at say 4.8 and I can build in decent seller terms, we're going to be raising a lot of money. If we gave investors a preferred return of say 7%, that would actually make sense for both sides. So now I'm looking at going, look, what works for Cadia, our group, as well as capital providers, and can we marry all these up into, is it worth sort of going into PSA and going further down the road? And then of course, and by the way, these are based on, I'm looking at a pro forma, I'm looking at some rent rolls. I don't have occupancy numbers yet. We're swagging the upside. Yeah, I'm going, look, May, June, July, August, September, those are our busy months. If those are 50% occupied, I can increase by maybe $20. So we're running these like basic models, but it's enough to get into contract. And then of course we have a lot more to do.
Yeah. I mean, just to finish the conversation on this RV park, we were just in this office, because again, Mitch comes and loiters at my house all the time. We were in this office trying to figure out, do we get into contract?
Yeah.
And because it was interesting, last week, she's like, okay, fine. The sellers are willing to come down to 4.8 million.
Yeah.
So one of the quick, I'm just looking at our whiteboard here. One of the quick exercises we did, like Mitch is all, we haven't even put this into an advanced pro forma tool yet. We're just like looking at this going, does this make sense? What's the current NOI? Does the current net operating income make sense based on their financials? Does that expense, and we actually, I think the expense ratio is a little low, what they're marketing. Yeah. So we pump up the expense ratio and we match that with the RV park that we have here, because there's a lot of similarities. And like, even at that expense ratio, where we're like, okay, this NOI actually looks interesting. We could actually give investors 7% pref. We can do all right with that. because I think it's got a global like 10 or 11% cash on cash sort of
so
going in.
50-50 after that. Yeah.
So we're like, okay, that works. That could work. Worst case scenario, we're coming in with a lot of cash. I like it because our debt hurdle is really low. I mean, or really high, I should say. Yeah. It's like a 2.4, which gives you a lot of cushion, and it preserves your capital. It de-risks the deal significantly. A lot of people don't understand that DSC, our debt service coverage ratio, is not just a bank thing. You should be looking at that too.
No, it's a safety margin.
Right. It's a buffer. But then we looked at it and we're like, yes, these rates are pretty low. It's year round. What if we took these busy months and we raised rates by, I think we're looking at this like $15 a night. And what if we were still at 50% occupied in the busy months? Interestingly enough, the global cash on cash goes up considerably. That brings our investors' cash on cash north of 10%.
Yeah.
We're doing really well. We're having a good time. This thing's working. And then we get in and we start looking at the park and we look at their bookings rates through like June, July, weekdays, weekends, May. We're like kind of just spot. And we're also checking some of the competing parks in the area. And we're like, I think 50% is really, really conservative. Like these things are booked. This is probably like 80 to 90% in the busy months. So we're like, okay, well, let's bump it up to 60% occupied.
Exactly. And so the other thing too, when you think going back to dynamic pricing, when you think about dynamic pricing, we're running a very rough model here. We're going, look, let's just do 15 or 20 bucks a night across these nights. But in reality,
and being conservative.
Exactly. Yeah. Because we want to be conservative going in. But in reality, say we were to buy this park, just like our local park, dynamic pricing really should adjust with demand for the site. The demand for one site throughout the year, depending on the month and the day, changes drastically. And there's no way to, maybe you could chart it out, but like if you just think about this philosophically, one pad in the middle of December is value and demand is very low, not that high at all. But now think about Wednesday in July. It's pretty high. But now think about a Friday or a Saturday in July. It's at its all-time high.
Tons of demand, very little supply, or no supply hardly.
No supply, massive demand. So your prices should reflect that. So in the middle of December...
You sound like a capitalist.
Very much. So in the middle of December, your price is going to reflect that low demand. On a Thursday or Wednesday in July, it's going to be a lot higher. But on a Friday or Saturday, it should be even higher because people are going to pay. That is the most valuable night possible. And the first thing we do, just like the local park we go, look, it's a fixed rate. The whole year's fixed rate, no matter what night.
Just buy the thing because there's so much value add right there. Yeah.
Yeah. And I think that, like you said, the airline industry does the same thing because they understand that demand changes. You have a product, the product stays the same. The demand cycle changes depending on the day or the month.
Right. Yeah. And I think, and it's technology, inexpensive SaaS-based technology that implements all that. Yeah. It builds the algorithm.